Mortgage rates are holding firm at their lowest levels in more than a year, extending an unusually calm streak that's lasted for nearly 2 weeks. On average, lenders are offering rates just above the lowest levels seen in more than 3 years, giving borrowers a rare window of stability in an otherwise uncertain financial environment. The steadiness comes despite broader market turbulence, as the ongoing government shutdown has paused major economic reports, leaving investors without key indicators like inflation, jobs, and consumer spending data. With fewer signals to follow, the bond market, the primary driver of mortgage rates, has been reacting to smaller developments, including new tariffs and recent volatility among regional banks. Over the past several weeks, bond prices have moved gently higher, keeping yields and, by extension, mortgage rates near long-term lows. The 10-year Treasury yield, a key benchmark, dipped just below 4%, suggesting investors are leaning towards safer assets even amid uncertainty. Rates are holding steady at the best levels we've seen in over a year, one senior loan originator said. This consistency gives buyers and refinancers a much-needed chance to plan without worrying about sudden spikes. Without new government data, the markets are treading water. Analysts say the vacuum has amplified the impact of minor headlines, with tariff policy and regional bank liquidity concerns nudging investors toward bonds. This flight to safety behavior tends to help mortgage rates, but most experts agree the calm won't last once the government reopens and the flow of economic data resumes. Still, signs of market fatigue are emerging. After weeks of improvement, bonds appear to be hitting resistance near current levels, raising the possibility of a modest pullback. We're seeing some natural resistance around the 4% level on the 10-year yield, said a fixed income strategist. For rates to improve further, we'd likely need weaker economic data or a major policy surprise. For now, borrowers are making the most of the moment. Refinance activity has increased, particularly among FHA and conventional borrowers who locked in higher rates earlier this year. Some cautious buyers are stepping back in, taking advantage of the rate stability before potential market swings return. Mortgage analysts caution that this calm period may prove fleeting. When the government reopens and delayed data, like inflation and employment reports, finally hits, volatility could quickly return. This kind of calm in mortgage rates doesn't last forever, one expert noted. For now, steady is a gift. In the big picture, rates remain historically attractive, hovering near multi-year lows despite lingering inflation and global uncertainty. The current stretch of stability has offered a breather to both borrowers and lenders, but it's a fragile piece, one that could shift quickly once the data flow resumes.